Hello, welcome to this session. So, I'd like us to talk about something small. So, this is week three. This is week three, and we are talking about the smart liquidity concept. Let us look at the core framework of the SLC. I believe you've watched video one, and video two. Now, this is the third video. Let's begin. Price 6 liquidity. Learn where it lives, and you know where price is going. So the basic or the core framework of how we look at price at the worm is you need to understand liquidity. And as I mentioned in week one or video one, I talked about liquidity. I said liquidity is the ease with which you can buy and sell. You can buy and sell. Okay. And I gave an example that let's say you want to buy land. You want to buy land worth 10,000 acres. Are you sure you're going to find a seller immediately? No. If you want to sell land, 10,000 acres, are you sure you're going to get a buyer immediately? Very rare. But in the Forex market, it's possible to buy something worth a million. Yeah. Now, let us continue. So, the primary objective of this lesson right here, the primary objective of this lesson right here is to understand. You as a student, you're supposed to understand and identify and reason about liquidity as the driving force behind price movements. Okay, you need to understand that liquidity is the reason why price moves. Basically, price seeks out liquidity and feels liquidity and trades away from liquidity, trades towards and away from liquidity. So they call them institutional thinking, seeing the market from the perspective of a large order flow. So our psychological focus is shifting from reactive to predictive thinking, seeing the trap before it springs. Welcome. Now, what is liquidity? What is liquidity? That's the first question. What is liquidity? Liquidity basically is the engine of price, is the fuel of price. Liquidity is the lifeblood of Forex. For every buyer, there must be a seller. For a large institutional order to be filled, there must be an opposing order of equivalent size available. This is why institutions move price to where clusters of orders exist, not randomly, but with purpose. Okay? This is the entire foundation of the smart liquidity concept. Okay? So, number one, what you have to understand is that retail traders, retail traders behaving predictably creates these liquidity pools. So there is something known as liquidity pools. Okay, liquidity pools is where most of retail stop losses are resting. Let's touch on them. Number one liquidity pool is equal highs and equal lows. Anywhere you anywhere in the market where you see there are equal highs and equal lows, when price touches the same level twice, retail places stop losses above or below, expecting breakout, and institution rate these first. Okay, so when prices touches the same level twice, retail traders place stops above or below that level, expecting breakout. Institutions know this and engineer price to take those stop losses before reversing. Number two is the previous day highs and lows, PDH and PDLs. These are heavily watched levels. Stops cluster Stock clusters accumulate above or below them. This is the prime liquidity for institutions. Number three liquidity area are we've talked about PDL and PDH. Number three we're talking about swing highs and swing lows. Any obvious structural swing point carries top orders from retail traders. Okay, institutions know this and they know exactly where they are. The next one is trend line clusters or trend line and moving average clusters. These are widely used by retail traders, creating orders, creating order clusters that institutions target. So our key insights here is when you see a price breaks a level and then reverses, it's not a false breakout by accident. It's a deliberate liquidity raid engineered to fill institutional orders at a premium or discount level before they remove. Now let's see how it happens. The common types of liquidity pools. Number one, we've talked about equal highs and equal lows. So in the market, anywhere you see there some triple highs, triple or quadruple highs, equal highs, yeah. This one is like a support area. This one is like a resistance area. This one is like a support area. So what happens? What do retail traders see? When they see this one as a resistance area and price comes to this level, then it sells, comes to this level, then it sells. So they look to sell at this point, okay? And what do? They place the stop losses right above here. When price comes to this level, retail traders look to buy, okay? They look to buy. Their stop losses are resting below this point. So that is why I'm saying above equal highs and below equal lows, there are lots and lots of liquidity pools. Okay. Number two, whenever we've talked about below swing lows and above swing highs. So when price breaks a structure, let's say this one's a break of structure. Okay. At this point, below this point, there are stop losses. Why? Because when you look at how most retail traders trade, let's say breakout traders, they wait for price to break out this structure, then enter buy positions. Their stop losses resting below the swing lows. Okay? And above, the same is for these ones. Yeah. Above these points, there are liquidities. Okay? Liquidities. Same to this point. They see that price has come to this point and shifted. So they wait for price and they look to short. Okay? Stop losses above here. So the same with these ones. Stop losses below here. Double bottoms and double tops are areas of liquidity pools. Also, there is something known as trendline liquidity, where basically trendline traders wait for first touch, second touch, then third touch of trendline, then they look to short. Same, first touch right here, second touch right there, third touch right there. They look to long. Liquidity pools are resting below these points. Okay. So these are some of the most obvious liquidity pools. Okay. I want us now to get into some technical. I've just taken a sip of water. Let's continue. Some technical analogies. Now, there is something known as buy side liquidity and sell side liquidity. Okay. Buy side liquidity basically means sits above prices where stop losses of short sellers plus buy orders are resting. Okay. Buy side liquidity or BSL basically is formed by stop losses of short sellers and buy stop orders of breakout traders. Institutions drive price up to this buy side liquidity before reversing towards downwards. Let me explain using this one here. Now, I'm talking about buy side liquidities. You see, when we began this liquidity session, we've said that for every buyer, for every buyer, there must be a seller. For every buyer, there must be a seller. Okay? Now, at this point, let's take this point right here. This one is a resistant point or equal highs. Okay? So, Retail traders are selling, are looking to sell from this point. Their stop losses are resting right above here. Their stop losses are resting right above here. Now, if they're selling at this point, stop losses above here, meaning that these stop losses are buy orders. The stop losses of sellers are buy orders. Okay? That is why above here, there are a lot of buy orders resting. Lots of stop losses resting here. And those stop losses are buy orders. If you sell at this point, then price comes back to your stop loss. You will be buying back at a worst price. So these ones are just buy orders. That is why they are called buy side liquidity. Buy side liquidity. The same applies for sell buyers. Buyers who are looking to buy at this point, stop losses, the stop losses will be resting below this point. Now, if they're buying at this support area, stop losses below here, meaning that their stop losses are sell orders. So these sell orders are sell side liquidity. These sell orders are sell side liquidity. That is what I want you to understand. So I've said buy side liquidity sits above price, while sell side liquidity sits below price. Stop losses of long traders and sell stop orders. Institutions drive price above to take the buy side liquidity, then reverses down. Remember in the second session we talked about AMD, where this is the accumulation phase. Then institutions drive price above, taking all buy side liquidities before driving price downwards. So this is the accumulation, manipulation, then distribution. Same as this point. Drive price downwards, then push price up. Okay. The retail traders see this one as a breakout above the resistance. And with us, we know that this one is a liquidity raid before the reversal. Whenever you see such a thing, price sharply raiding this buy side liquidity, then reversing, that one is a liquidity raid. Okay? Start noticing these things on your charts. Kindly start noticing these things on your charts. Okay? Same as sell side liquidity, where they drive price downwards to take sell side liquidity before reversing price upwards. So, like here, they drive price downwards, taking all the sell side liquidities before driving price upwards. Okay? In this scenario, you'll find something like this. They drive price taking all liquidities that are resting below here, then the continuation. Now, let us get into the nitty gritties of this system. There is something known as order blocks. There are some things known as order blocks. Okay? These are institutional footprints. As I said, institutions cannot hide their movements. An order block is the last opposing candle before a significant impulsive move away from a level. It represents the candles in which institutions place their orders. The last opposing candle before a significant impulsive move away from a level. So if it's a same we having, let's say we having price consolidating, then the last sell candle before an impulsive buy, this one is the order block. The last sell candle, this one is the order block, OB. So price usually returns to this level, to these zones, remaining to fill the remaining institutional orders, creating price reaction that SLC targets. Okay, so you find that price pulls back to these order blocks where institutional orders remained to fill the remaining institutional orders. Then now the continuation plays out. I'm going to show you these on the chart. So if it is a buy, if you've seen an impulsive buy, look at the last sell candle before the impulsive buy. So for a bullish order block, the last sell, the last bearish or red candle before a strong bullish impulse. So price returns to that level and institutional buy orders fill, then react. For selling, the last green candle or the last bullish candle before a strong bearish impulse, price returns to that level, and institutional sell orders are filled and reaction bearish. So number one, the high quality order blocks preceding a break of structure. So number one, it has to be before a break of structure, and it should not be mitigated or tested, and it should align with higher time frame buyers. All three are required. Number one, we say that number one, it has to have a break of structure. Okay. Number two, it should not be tested. It should not have been retested or mitigated, not mitigated. Okay. Number three, it should align with the higher time frame bias. So zone drawing, draw the zone across the body of the qualifying candle. Some of the traders include wicks. Okay, let us see. And also there's something known as fair value gaps. Okay, let me talk about order blocks. Let me add something small about order blocks. Is that not all order blocks are the same. Not all order blocks are the same. Okay, the analogy of order blocks is like an order block is like a shop, ni kama duka, where institution places their orders. Institution place their inventory there. So when price comes back to the shop, they sell more inventory or buy more of them, and price react. And the price reaction is that the candle is not coincident. It's like a business. Okay. Now, what are fair value gaps or imbalances? Imbalance or fair value gap in prices. A fair value gap occurs when three consecutive candles creates a gap between the wick of the first candle and the wick of the third candle. Price moves so fast that no two-way trading occurred. Markets naturally returns to fill these imbalances precisely. Let me show you how this one happens. If you've seen a series of same consecutive candles, let's say by candles, okay, three consecutive buy candles. So this is the week. This is the week of the first candle. Let me change the color. This is the week of the first candle, and this is the week of the third candle. So you look at the gap between the week of the first candle and the week of the third candle. So this is the first candle, and this is the third candle. So look at where the wick reached. This is the upper even the figure. This is the wick. Okay. So this gap here is what is known as an imbalance or a fair value gap. So usually you'll find that price usually comes back to fill these gaps before continuing. Okay. Price returns to fill the gaps before continuing. So, or they're also known as fair value gaps. So bullish fair value gap is the gap between the first candle high and the third candle low. First candle high and the third candle low. Price retraces back into the gap before continuing higher, as I've said. So for a bearish, it's still the same. Bearish, you see these series of three consecutive sell candles. Then I said you look at the low of the first candle. The low of the first candle is right here. Then the high of the third candle. The high of the third candle is right here. So this gap right here, price retraces up into the gap in a bearish context. So you'll find that price inarudi hapa, then the continuation inaendelea. So whenever you see an order block plus a fair value gap confluence overlap, this is the highest conviction of entry price. Okay, both institutions and algorithm align. So a fair value gap is also called an imbalance gap. They occur between three consecutive candles, creating a gap between the wicks of the first candle and the wicks of the third candle. Meaning price moved so fast through a zone that no true two-way trading occurred there. So usually you'll find that the market usually comes back. to fill the gap before continuing. So there is also the market has a tendency to return to fill these imbalances, not because of any mystical force, but because the algorithm driven nature of institutional price delivery seeks balance. Okay, let us continue. Let me show you how the smart money SMC. I know you've heard of the SMC. How these guys trade. Number one, smart money traders are retail participants who base their strategy on tracking the footprints of institutional players like central banks, hedge funds. Instead of using traditional retail indicators, they focus on the market structure, liquidity, imbalances to find high probability trade setups. So, the key principle of SMC trading or SMC traders rely on several core concepts that interpret the market. So I want you to be keen on how smart money concept traders trade, because hapo mbele tutazitumia. We are going to use it. We are going to use this one. Okay? So number one, they wait for a break of structure. This one is a break of structure. Instead of a standard trend line, SMC traders use specific acronym to track trends. A break of structure means that price is continuing in its established trend, while a change of character signals a potential trend reversal. In our last class on market structure, we talked about these. Then they wait for liquidity zones. Institutions need large amount of opposing orders to execute their trades. SMC traders identify these areas where retail traders place stop losses, known as liquidity pools or sweeps, anticipating that smart money will push price to grab this liquidity before moving in the actual direction. So you'll find that price is creating trendline liquidity, like this one is a trendline liquidity. Then it left a gap up hivi. So another thing, order blocks. These are specific key candles, usually the last move in the opposing direction before a major impulse, where institutions are believed to have placed their large orders. Traders wait for the price to return to these blocks for them to enter trade. So they wait for price to come back to these order blocks, order blocks or demand zone, order block. So we have something known as demand zone or supply zone. So for a buy, this one is an order block. For a sell, okay, for a buy, this one is a demand zone. For a sell, this one is a supply zone or an order block. Okay. So another thing that they usually wait for a fair value gap. This occurs when there is a strong directional move or a large candlestick with small wicks, leaving imbalance in the market. SMC traders view fair value gaps as magnets that price will eventually return to fill. So as price returns to fill these gaps, hii yenye unaona nimeweka hapa hivi, this one is a gap. When it returns to fill them and fill the order blocks, they look to short in this scenario and they look to long in this scenario. As we have seen, I've talked about the gap and I've talked about order blocks. Okay. Now, let us see them in the charts. Let us see how they occur in the chart. So as you can see right here, number one, we said you need to see a break of structure. Then look at the last sell candle. As you can see, if you zoom, you'll see something like a red candle. So price returns to these gaps, and also there is this fair value gap right here. Fair value gaps. So price returns to this zone, then they look to buy. Okay. In this area, this is one of the last sell candles. So price did not return to this area. In this scenario, this one was the last sell. Price returned to that area, filled the gap, continued. Same here. Break of structure, pullback to this demand zone or order block, then they look to buy, targeting these areas. Okay. Now, there is something known as premium and discount zones. Premium and discount zones. These are precision entry zones. Okay. Within any structural move, price oscillates between a premium of extended or a discount value areas. So we see that buy buy in discount and sell in premium. This maximizes your risk to reward on every trade. So an equilibrium is the 50%, the midpoint of any structural range, and acts as a driving line between premium and discount. So let me show you how it plays out. This one is a break-off structure. This one is a break-off structure. This is a swing low and this is a swing high. So there is something known as a Fibonacci, where you'll use a Fibonacci to measure your 50% zone. So you'll find your 50% resting right there. So let me change the candle and the color. So this is the 50%. This is the 50%. If this one is a 50% zone, this one becomes the premium and this one becomes the discount. So any order block that rests in the discount zone, okay, any order block that rests in the discount zone, it's a high value order block, and the price usually looks to pull back to that area and buy from that area. So 50%, the equilibrium is the 50%. The discount zone is below 50% range, while the premium zone is above the 50% range. That's an optimal sell zone. In our scenario, we'll have something like this. We had a break of structure right there. This is a swing high, this is a swing low. 50% is at this area. So we say that sell at premium zone. So this is the premium zone where you need to look for sales. While at the discounted zone, you need to look for buys. So price retraces to this area, then sell. Continuation from a fair value gap, from a supply zone or an order block. So the golden rule: never buy in premium, never buy in premium, and never sell in discount. If your if your analysis says buy but price is in premium, wait. Wait for pullback to discount before entering. Let me show you an example. Let me show you an example. Okay. This one, this one is our break of structure right here. This one is our break of structure. So our 50% area. So this is the swing high. Swing high. You'll have to excuse my beautiful handwriting, eh? And this is the swing low. Now let us look at a demand zone. This one was a demand zone, but it was a decisional demand. We say that order block, the last sell, the last opposing candle before the impulsive buy that caused the break of structure. So price pulled back to this demand zone. Any person who was looking to buy from this point, stop loss yake ilikuwa hit. Any person who was looking to buy from this point, we can see the first stop, the first guys, the second guys. Then the third guys, the demand, in the extreme demand, the last sell candle that pushed price to break structure and add gaps that are left here, plus liquidity. This one. So the demand zone is the last area. So you can see we say that you buy from a discounted zone. So this one is the most probable discounted zone to buy from. Okay. Discounted zone. This was the most probable discounted zone. You would have just entered at this point, the last extreme zone, and target this high instead of this one. So here mtu aliingia hapo alikula loss, hapo alipata loss na huyo mwingine akapata loss. Now putting it all together, how they're looking to trade. So number one, identify the high time frame buyers. Are we in a bullish trend or in a bearish trend? Confirm the daily structural state, bullish or bearish. Do you have a series of high highs and high lows? This one is market structure. If you don't know this, go back to market structure video that I created, the last video. This never changes mid-trade. Number two, identify liquidity targets. Identify the nearest buy side or sell side liquidity that price is likely targeting. This becomes the context of the next move. Identify liquidity. We've talked about liquidity. Look at the higher highs, higher lows. Look at the trend lines. Look at the swing highs, swing lows, okay? Then wait for a manipulation. Wait for a price ride. Look at the accumulation, manipulation. So wait for manipulation. Price to sweep out the buy side liquidity or sell side liquidity, triggering all stop retail stop loss. Then look for an order block or fair value gap in the discounted zone. Okay. Look for bulls or premium zone for bears. Like these confluences are two factors that are required. Then wait for a lower time frame confirmation. Entry triggers. Go for a lower time frame, either 5 minutes or 15 minutes in the direction of the high time frame buyers. This confirms the institutional engagement. Okay. Enter on the confirmation stop below the order block. Target the next liquidity zones. So this is what I mean. If you see a break of structure, this is our order block. Okay. Then price, you'll find that price is accumulating. Price raids the stop losses that were resting below here, comes and fills the fair value, the order blocks. Once it fills the order blocks, go to a lower time frame. Once in the lower time frame, wait for a confirmation. Then enter on the order block, targeting the next liquidity point, targeting this point. Okay. So you are aligned with the high time frame buyers. You've identified the liquidity. You've waited for manipulation, and you've seen the reversal signal. Okay. Then you go to a lower time frame confirmation and execute on the order block. So when you see price breaks a level, then it reverses. Let's say we had something like this. When you see price breaks a level at this point, then it reverses immediately. It was not a first breakout by accident. It was a deliberate liquidity raid. So remember, liquidities were resting here. It was a deliberate liquidity raid engineered to fill institutional orders before the real move. So after this one has been triggered, then now the real move is being printed, targeting this next liquidity. So what you can decide to do is, once it has been raided, look for an entry at this point, target this liquidity resting below here. So we'll talk about entry models in the next lesson. But as I finalize on this, I need you to go and identify buy side liquidity and sell side liquidity identification. Mark out all buy side liquidity and sell side liquidity on the Euro USD on the 4 hours for over 30 days. Go back to your charts, do this work. Okay. Identify the previous days high and lows, equal highs and lows, swing liquidity. Discuss which were raided and which weren't. Look at order blocks. Remember, order blocks, there are some that I've showed you, there are some order blocks that fail, like this one right here. These ones failed. This additional failed, but this extreme one uh, played out. So look at that. Then look at fair value gap identification. Go and try identifying them. Okay. On your charts, mark out premium and discount levels using the Fibonacci. Okay. Then follow the full smart liquidity concept walkthrough of starting from higher time frame coming downwards to M5. Independently find one setup. The buyers, liquidity, entry zones, stop to target. So some of the common mistakes to avoid. A valid order block must precede a meaningful structural move. So calling every pre-move candle an order block. No. It must have had a break of structure. Lazima ikuwe ilikosa break of structure like we have seen. That's a valid order block. Okay. Lazima ikuwe na nini. The next one, treating all fair value gap equally. Fair value gaps zenye zimekuwa formed during Asian session, these are low quality. Remember we talked about session in our first lesson. Okay. So but fair value gaps zimekuwa formed during London and New York are high quality. Time context is part of your assessment. You see an order block, I should enter. Order blocks is on. You need a lower time frame, LTF lower time frame, break of structure confirmation before entering. So once price imerudi to your order block, go down to a lower time frame, anza kuangalia shift, change of character, look to play the continuation. Enter blindly on an order block without confirmation is gazing. So trading order blocks and fair value gap against the hard time frame buyers. If the daily is bearish, you're buying into, you're fighting against the institutional trend. You need to trade towards or in line with the trend. So my assignment, as I've told you, mark out the buy side liquidity and sell side liquidities, identify unmitigated order blocks which are not tested, look at fair value gaps mostly during London session and New York session, and paper trade. Paper trading basically is going uh, on a demo account and try applying what you've learned so far up to this point. Okay, up to this point. So, in case you have any question or anywhere you need clarification, just be sure to write it down on the comment section. So, this is TWR Academy on Smart Liquidity Concepts Core. So, peace out. This is Trader Zambezi. I learned the recording at this point.